US bond markets flash recession warnings and global investors rush to safe havens. Bond markets are rarely mentioned, even in the finance segments of general news updates, so to hear bulletins this week led by discussion of the US yield curve was surprising indeed. The key driver for this was the US yield curve inverting for the first time since 2007. An inverted yield curve where the difference between a yield on, say, a 10-year US government bond and a 2-year bond is negative has long been touted as a harbinger of US recession. So the fact the US curve inverted this week arguably played a significant part in the 3% tumble in US equity indices on Wednesday and a torrid week for markets around the world. Now, whether the US curve is predicting a recession or whether it's merely reflecting the enormous quantitative easing from the Fed, ECB and Bank of Japan, plus aging population and technology change remains to be seen. However, the US yield curve has correctly predicted the last 5 US recessions, and the last time the US 2-10 curve inverted was in 2007, well ahead of the global financial crisis. And given this reputation, global bond markets went into a buying frenzy this week. The UK curve also inverted. The complete German sovereign bond curve out to 30 years now trades with a negative yield, and 10-year German bond yields hit an all-time record low of minus 71 basis points, which effectively means buyers of these bonds are paying the German government almost 0.75% for the privilege of keeping their money safe. Indeed, of the 55 trillion of top-rated government bonds that are included in the Bloomberg Barclays Global Aggregate Bond Index, 16 trillion are now negative yielding. That's an incredible 28.5%. While traders are focused on the probability of a recession in the US, it's been a poor week for data around the world too. UK Q2 GDP released the previous week printed negative. German Q2 GDP released this week was also negative, as was growth in Singapore in the second quarter as well. And Chinese industrial production came in well below expectations at the lowest level in 17 years. However, here in Australia, economic data has been less negative. While business sentiment confirmed that weak conditions extended into the September quarter, consumer sentiment rose a surprising 3.6% in August. This bounce follows 2 RBA rate cuts in June and July, and economic forecasters predicting further cuts in coming months, and that's likely helping the consumer's mood. The other positive this week was a re-acceleration of job creation, with jobs up 41,000 and full-time work up 3% on the year. Record high participation means the RBA will have to keep pondering further easing, with the unemployment rate not budging and wages growth still sluggish. We tend to see the Australian dollar consolidating around the 68 level into next week, though key will be important updates from both the Reserve Bank of Australia and the Fed. The minutes from the August 6 RBA meeting will be released Tuesday, the minutes from the July 31 FOMC meeting on Wednesday. These are important opportunities for both central banks to guide market pricing. There's about 4.25% cuts priced into the US curve by the end of next year and 2.5 rate cuts here in Australia. So any tilt to the message could see some volatility in markets midweek. Thursday also brings the beginning of the important Kansas City Fed's annual retreat in Jackson Hole, Wyoming. This year's topic is the very fitting challenges for monetary policy, and global bond markets will clearly have given the attendees an awful lot to think about. We also have the French G Summit next weekend, where the focus is set to be on fighting inequality. Finally, note we get the first read on global PMIs for August on Thursday next week, providing an important update on global economic activity. These are all factors we'll talk about in next week's Markets Update.